Before we dive in, just a quick disclaimer, I am not a financial advisor. This video is for informational and entertainment purposes only and is not financial advice. Always do your own research and never invest in anything based solely on what you see on the internet. Now let's get into it. So guys, I would give an introduction, but I am sitting here with a man who needs no introduction, the one and only Professor G. Nolan, man, it has been too long. How you doing?
I'm doing good, my friend. How are you?
Can't complain, man. Things are going really good. We've got some really interesting questions picked out today, and thank you to everyone in the audience who submitted them. Are you ready to get into it?
Yeah, man, I'm excited. Those are some good questions. Love it.
We'll kick it off with a kind of a hard-hitting one, a little juicy one. And I know you just talked about this too in a recent video, but is SCHD, the one and only SCHD, still a great buy and hold long term? How you feeling about it?
You know this one's going to get a lot of comments down below. Yes, I mean it just straight up. I'm just going to say yes right off the bat here. And the issue is, people, that right now we're in a very tech-heavy situation, right? And so the fun stocks to own, the fun ETFs to own, the things that have been crushing it for the last 3 years, very tech-heavy, very AI-heavy, very much built on hype, which, not that I think that we're in an AI bubble or anything of that nature, but I do think that valuations are incredibly high and they're priced to perfection, so you need to be careful. But I would just say that everybody is there. That's where the money is. That's where the excitement is. And so the ETFs that don't have very much tech exposure and almost no AI exposure obviously are underperforming a little bit. And that's what SCHD is. That's what a handful of other ETFs are. If you think that your ETF is going to perform like crazy in all times of the market, maybe want to check the history on
Yeah.
anything. But all that to say that I just think that, the market has different cycles. Right now, we're in a very growth-heavy, AI, tech-heavy cycle. At some point, that will stall out as valuations catch up. And at that point, value investing will be the it thing again. What do you think?
No, absolutely. I don't know much what more I can add to that, but I do think if and when the cycle does swing back to something else, SCHD or those type of stocks do come back into favor, I think you'll be glad that you have it. And I think overall, when you zoom out, I think SCHD can still play a really important role in a well-balanced portfolio. And personally speaking, I've been getting questions about this all the time, and I'm still dollar cost averaging into it every single week as part of like a well-balanced approach. And on the other side of that is, something like the S&P 500. And I've probably beat a dead horse with this, but I really think those two offer like a great all-weather portfolio and allows you to capture, the upside of whatever is going on in the market at that time. So to your point, like there will be a time where tech and AI and all the things that are being hyped up right now cool off. And like I said, at that point, I think you'll be glad to have something like SCHD in your portfolio. So to those of you who are getting discouraged or have possibly even jumped ship on the ETF, and I know there's a lot of people out there, I would encourage you to just kind of zoom out and take a longer term approach, because the things that are hot right now don't stay hot forever. And like Nolan said, the market tends to swing in cycles. So yeah, I think you pretty much hit it on the head with that. So
Yeah, no, I would agree with you. I think, just in general, I'm definitely increasing the value portion of my portfolio. I think one last thing to add here is just think of any good investor that you've ever looked up to, any good books that have just been like, around for years and years and years, 20 years, 30 years, 40 years, Warren Buffett, people like that. The one thing they always say is go against the grain. If everybody's doing something, it's probably a good idea to question and possibly go the other route. And right now, everybody's in the AI tech space. It seems like the easy money for right now. And as soon as that stops, you're going to really see who has the balanced portfolio and who doesn't. So yeah, that's why SCHD is still a huge portion for me.
you'll see who's quote unquote swimming naked, which maybe we don't want to see. Maybe we'd rather not see that, but all right, man. Good stuff. Let's move on to the next question. This one comes from my friend Christian, actually, who says, is there anything you did in the past that you regret doing instead of investing? And on the flip side, is there anything you regret missing out on because you chose to invest instead? Does that make sense, those two questions?
Yeah, I think so. Do you have a thought on that?
Yeah, yeah. So as far as like the regret doing instead of investing, I remember when I was in my in my teens, actually. I started working when I was 16. From about 16 to 21, I just worked, lived at home, and saved up a ton of money. And then when I went away to college and was a full-time student for that period of time, I wasn't working. And this was right around when I turned 21. And it really did not take long and I think I probably saved up close to maybe about 20 grand. So it was a good chunk of change. But anyway, it did not take long for me to blow through all of that stuff. And I look back on that period of my life and I think, man, I wish I could go back there and maybe not all of it, but at least a certain percentage of it. I wish I would have taken that and I wish I would have started investing because I can't help but think what that would have turned into today. But such is life. And, everyone finds their way to investing at different times. And, it's an important part of the journey. And with that said, too, I think everyone who's gotten into investing looks back and says, I wish I would have started sooner. So that's something you'll just hear every investor say. I've heard 12-year-olds say that. But on the flip side of that, is there anything I regret missing out on? To be honest with you, not really. More than anything, I wish I would have started investing sooner. And truth be told, I feel like I live a pretty well-balanced life where, I have fun and also, set aside a lot of money for investing. So I kind of get the best of both worlds there and don't really feel like I'm missing out on too much, especially because investing is a hobby. This is something that I love to do. This is not like something you have to twist my arm to do.
I think this question too, from what I've heard from like my private clients or just people that I've talked to, is that they wish that they would have started earlier. And to your point, yeah, I wish I would have started a little bit earlier too, but you and I are both pretty young in the grand scheme of things. And so I think there's not a lot of people our age-ish that are investing as heavily. And so it's tough for me because I'm like, I feel pretty good to have started investing when I started investing. I think that one thing for me that I don't know if this answers the question or not, but I'm the opposite of regret.
Yeah.
So I
Okay.
didn't start investing right away, I guess, when I was, I don't know, 20, 21, 22. More so, my goal and my thought process was all around building businesses. And so what I could have done is, instead of build a business, like take on debt, build business, I could have went the traditional route and just got a regular job and then saved a portion of it and had a 401k building at that early time. But I went the other route and instead didn't really start investing till like 25, 27, like that,
Okay.
closer to that range, at least heavily. And it was because I was building businesses at that point, and now I'm to the point where I've sold a couple of businesses, and I'm, have a couple of businesses that I run now, and the amount of money that that's bringing is more than what I think I would have had I started much earlier. And so I think I always had the goal in mind to get to a point where I had some extra disposable income and then be able to invest as much as possible. I think you and I both have done a really good job of increasing our income, but not increasing our expenses as we go.
Mm.
And that's been probably the number one thing that I think has built both of our net worth as much as it has. So for me, it's more so I'm just happy that I am doing, the disciplined things that I talk about on the channel and that I hope my audience does. And I don't really have too many regrets at this point. I think that there's one or two crypto coins that I bought maybe like 5 or 6 years ago that I thought was going to go to $1 million and lost everything. So maybe that could be a regret, but
Yeah, you never know with that stuff. It could have just as easily went the other way and you could have, been living on a yacht by now. You just never know with those things. It's a moonshot.
for sure.
So, but that makes sense. And I will say, last thing before we move on to the next question, for all of you guys just now getting into investing, or maybe you're on the younger side getting into this stuff, um, like Nolan was saying, one of the most important things that's really going to make a difference for building your portfolio, especially early on, is your contribution. So I would really encourage everyone to maximize those early on if they have the capacity to do so, because that's really what's going to move the needle early on in your investing journey. until it reaches a certain point to where the compound interest can start to move the needle a bit more. But if you're just getting started, your first 10,000, your first 20,000, 30,000, what's really going to bump up that portfolio value is going to be your contributions more so than your dividend income, or more so than any share price appreciations, unless you invest in some other crypto stuff that Nolan didn't, and it does really, really take off. But generally speaking, work hard to increase your contributions, because it makes a huge difference for sure. But cool, man. Let's move on to the next one. This one comes from someone in your audience. Her name's Caitlin. And Caitlin wants to know, how do you know when it's time to give up on a stock? At a certain point, do you accept maybe your analysis was wrong? It's only a loss if you sell, but also if it keeps going down forever, you will eventually lose, and the opportunity to put it in something else is also gone. What do you think? How do you know? Sometimes actually knowing when to sell is even harder than knowing when to buy. So how do you reconcile that? What do you do?
Man, that's such a good question. Such a question I think every one of us, anybody who's ever invested, probably has come up against. I think number one, the first thing to do to be proactive for that is just to do as much research as possible before you buy into a stock. If the only reason you bought into a stock is because you heard Ryan talk about it, or you heard me talk about it, or somebody,
Big mistake.
that's terrible. There could be such a good company stock that works really well in my portfolio that would just be terrible for Ryan's portfolio. And it's because of different risk evaluation or profile or whatever it may be. So as long as you can do that research ahead of time, you have a good idea of why it's there, what the purpose is of the stock in the portfolio. And as soon as it stops doing that, as soon as it stops being that for your portfolio, it is time to question if you should get out of it, because it's absolutely true. A stock can go technically to zero, whereas most, solid passive ETFs aren't going to forever go down to zero or something, or else we're in a zombie apocalypse or something if the S&P
Yeah.
500 does that. To answer your question, it's tough because there's not going to be this sign that comes up and says the company is dead now, it's time to get out of it, or it's going to go to zero and then you should have gotten out of it earlier. For me, I don't invest too much into individual stocks. I don't have as many individual stocks as Ryan does, but I have had a couple of stocks that I've sold out of, and I've held on to them, years, and they never ever did what they were supposed to do. And so I just had to kind of rip the Band-Aid off and say, yeah, my analysis was off. I thought that it had a better trajectory, and it just didn't. And I would consistently see it's only growing 5%, 3%, whatever it is. And it looks like their competitors in the space are growing more. I'm watching their direct competitors grow by, 15%, 20%, and they're taking up market share. And if that's the case, it just seems like the writing's on the wall, and it's probably time to get out of that stock. For me, it's all about opportunity cost. So I would rather just say, yeah, a couple of $1,000s in this stock, it's a loss, it's not fun, but I'd rather take that, put it into something I do believe wholeheartedly into, and that has data to suggest that it'll continue to go up, and just go from there.
Yeah, absolutely. I think all roads just point to the operations of the business. If a stock's going to go to zero over the long term, it's because the business itself was suffering. And so that's really what you need to focus on. And that's where it goes back to what Nolan was saying, the importance of doing your research. And I think if your original investment thesis is still intact and you see the business over time kind of following the path that you thought it would, and sometimes it doesn't happen in our desired timeline. It rarely ever does. So that's another important thing to keep in mind. But I would say that if your original investment thesis and reason for investing is still intact and is progressing along, then I wouldn't necessarily throw the baby out with the bathwater. And this actually kind of ties back to what we were talking about with SCHD a moment ago too, because just the fact that other things are outperforming SCHD, or you can insert whatever other stock right now that maybe is not performing as well as others. Just because that's happening, it doesn't necessarily mean that the fund, doesn't necessarily mean that the company is broken. There's so many variables at play here. And so I think if we're just talking about an individual business, if you can look at the business and say, no, it's still chugging along just like I thought it would, even though the share price hasn't been doing what I want it to right now, The business itself is still healthy and it's still growing. And I would let that guide you more than anything else. So now we're moving on to 1, 2, 3. This is question number 4 from the Vector 751. Strong name. So Vector wants to know, when do you think a portfolio becomes over diversified? I currently hold 15 total positions. Okay, very specific here. 1 ETF, 4 penny stocks just to see how they do, 3 REITs, 3 monthly dividend stocks, and 4 other dividend stocks. A coworker says that's too many and that I should only hold 5 to 10. I've been considering adding a few more dividend stocks, but I worry I might be spreading myself too thin.
Yeah, it's a good question. I really do think that each portfolio can be, different compared, where the idea is that your portfolio may look different than somebody else's. So first of all, I just want to say the coworker saying like, hey, you should only have 5 to 10. Maybe he or she should have 5 or 10, and that's okay for you to have as many as you want. Again, it kind of goes back to what I was talking about from before. You hold positions in your portfolio for a certain strategic purpose. And if you need, 3 or 4 positions where somebody else needs 1, that still works out totally fine. I know people who have 50, 100 different positions in their portfolio, and it's perfectly fine. The thing that I would say is you start getting over diversified, in my opinion, if you're starting to carry the exact same things. So if you're carrying, like the S&P 500 and the total U.S. stock market, and then the top 10 companies that are in the S&P 500 and the U.S. stock market individually, you kind of have 12 different positions there, but it's all the same thing to a certain extent. You're very, very heavy in these specific areas. So what I would more so look at is where, how much fund overlap do you have? How much of a certain specific company, as far as percentage compared to the rest of the portfolio, do you have? And the more that you have, the more risk you have, obviously, but there also could be the possibility of more return. So I think over diversification, to sum it up, would be how much are you overlapping between the whole portfolio. On that note, though, I don't think some fund overlap is too negative. I think that that's okay.
Yeah, and it's kind of a hard thing to completely eliminate too. Like even just with SCHD and VOO, there's going to be some overlap, but it's not entirely a huge deal in that sense. So I definitely agree with that. The only thing I would probably add to that is that I think you'll naturally get a sense for if you are too over diversified. I think it's kind of, this is where investing becomes kind of like part art, part science. I think when it comes to the diversification, you can kind of feel if you are over diversified. I mean, you mentioned in your comment or in your question that you're worried you might be spreading yourself too thin. If you are doing that, especially as it pertains to the individual companies, you'll know. Like if you have too many positions or more positions that you can actively keep track of with the time that you have to spend in your portfolio, that could be a sign that you are over diversified. So I would listen to that. And I also think it kind of depends on the weighting of the ETF in your portfolio. Let's say this one ETF you have is 70-80% of your entire portfolio. You can probably get by with less individual companies if you wanted to. Once again, it's not going to kill you to have all those other ones, but you could probably get by with less. Now, on the inverse of that, maybe the ETF's only 10 or 20% of your portfolio. Well, then maybe it makes sense to have those 10 to, or however many, the 15 total positions. Maybe it makes sense to be a bit more spread out because the ETF is not carrying as much weight for you there. So that's my take. I think you'll feel it, and don't stress too much about it. It'll all work itself out in the end as you go along. Like I said, you'll naturally come to find your diversification sweet spot. That's what I like to call it.
I like that. I like that. And I think too, I guess partly when I was listening to that question, I can't help to think that possibly what was meant there might also be overcomplicate versus over diversified, because
Yeah.
that might be the situation. And I've run into that a bunch of times. Obviously, my channel is Investing Simplified, and the whole goal is to get it to as few positions as possible and to not overcomplicate it if it doesn't need to be overcomplicated. And so possibly this could be a situation where they're saying, should I have 2 positions? Should I have 15? Should I have 50? you might still be more diversified in a portfolio that has 3 positions than in one that has 10 positions, right? Like if you have 3 different ETFs and each one of them has 100 to 500 different companies within those ETFs, you really have like 700, pieces of the 700 different companies versus 10 positions that might be all individual companies. That's only 10. So the over diversification may be the issue here, but it might also just be the complicated nature. And really, for that, I always talk, when I talk with my clients about that, I just say, does it stress you out to look at this portfolio? Do you feel overstimulated? Do you feel like you can't sleep at night because you see all this red here, you see green here, you don't know what's what? Would it help you to only focus on 3 or 4 different things? If that's the case, then let's just, simplify the portfolio a little bit. And everybody's different. I know, Ryan, your portfolio has many positions. My portfolio has very little positions. We're both doing okay. So,
Yeah, doing okay. For now, let's knock on wood there. All right, man. Moving on to these, we have 2 more questions to get through. Both of them are really fun. I think these are really fun questions, at least. This next one comes from Lucas, who says desert island question. And this is actually a really tough one. You can only bring 2 books with you. Which ones are they? What are you bringing?
nice. That's a good question.
It's tough, man.
Uh, mine quickly, like right off the bat, would just be the Bible.
There
I
you
for
go.
sure would bring that. I mean, that's what I'm reading daily anyway. And I'm struggling to think that I would either bring a finance book or like not a finance book, because like
Yeah, yeah.
I'm on a desert island. I don't know. The other thing with finance books too is like I feel like when I read them once, I absorb the information or I don't, and I'm like, okay, but I would rather hear from something else. I actually like the Daily Stoic.
I knew it
Um,
was going to be Stoic. I was going to say his next one's probably going to be Letters from a Stoic.
and that's the other one because I was like, "Well, it's going to be one of these." But the Daily Stoic, at least it's like one every day, and so it's very bite sized. But for those of you that don't know what that is, it's basically this whole idea of we can't control what happens to us, but we can control how we react to that. So it helps frame my mindset a little.
To be honest, man, if you were stranded on a desert island, you probably would need both of those books. You might actually not survive without both of those books. So I think those are good picks. And actually, that makes my response here feel super lame. So I was thinking about this. I'm with you. I don't necessarily think I would take a finance book because, I mean, you've read 2 or 3 of them. You've pretty much read them all. Um, and so in thinking about this, I'm optimizing for like what's going to keep me busy. I have nothing to do on this island. I really need something here to pass the time. And so I'm going for like book thickness. I need something with a lot of pages. So number 1, I would go with The Snowball, which is like the definitive Warren Buffett biography. I think that's like 700 or 800 pages or something like that. Um, and then the second book, it's kind of a random one actually. I probably would take The House of Morgan by Ron Chernow. This is kind of like a history of the J.P. Morgan company and the Morgan family actually, and that one's another behemoth. That one might be like I don't think it's over 1,000, but it maybe is 800 or 900 pages. And I just figure, if I bring both of those 2, I could probably just read those back to back. And the time it takes me to read one, I'm probably going to forget what happened in the other one. So I can just keep cycling through them.
I like it. I like it. I think that would work out really well for you. And hopefully by that point, somebody will come pick you up.
Yeah, I'll tell you what. I'm definitely not bringing the intelligent investor though. That one's staying behind. Don't need that one on the island.
That's how you go to sleep.
Okay, so last question here, and this one comes from Rettler 1955. What's the number 1 or the top 3 dividend stocks to hold, no question, for the next 15 years? Now, I want to call an audible on this question if you don't mind. I want to expand it beyond just dividend stocks. I know I'm a dividend investor. I know, you appreciate the craft, but you're not as married to the dividend stocks as I am. So I want to open it up to just stocks in general. What's either the number 1 or the top 3 stocks to hold, no question, for the next 15 years? First of all, I want to know, sorry to ramble on, but I want to know how are you approaching the answer to this question? What are you thinking about? What are you optimizing for? And then what are the picks here?
Yeah. Great. I like that we opened it up because
I wouldn't do that to
I
you, man.
do.
I wouldn't make you stick to it.
No, I like that. I like that because my number one stock overall is not a dividend stock. But the way that I am thinking about this question is pretty much the way that I just look at investing, which is I like to understand history. I like to see data. So what I would want, if this is a no questions asked, you're holding this thing forever type situation, I would want to know how's it fared over bad market conditions, good market conditions, what type of company is it? Does it also still have a moat or a competitive advantage that it can continue even 10 years from now, 20 years from now, when we have new technology, new competitors, those types of things? So if it's weathered the storm for the past, 50 years, 30 years, whatever you want to call it, it probably has a good chance to keep going. I'm hoping, or it needs to be a healthy company. It needs to have a lot of cash on hand. It needs to have a high profit margin, and good leadership. So those are what I'm thinking. So I have two. So I'll give you the dividend one first, which is going to be a cop out. It's a very low dividend, but it's
Okay.
Microsoft. So
Okay.
Microsoft, I just think that they have such a competitive advantage, such a moat that can't be messed with. Uh, Not only to us retail people, but the governmental contracts is just nuts. They also have a better credit rating than the US government as far as how they handle their money. They've done a really good job there. Their profit margin is insane. I mean, just competitive advantage in all places, but then also the amount of money that they're spending on research and development for the next 10 years, especially with this AI push, is nuts, and they're closely tied with OpenAI. So I mean, I just think that Microsoft is one that there's a reason why it's one of my top stocks in my portfolio. And then the top number one stock for me is Berkshire Hathaway. So
Yeah,
Berkshire
yeah.
Hathaway is has zero dividend, so that one wouldn't have worked for that question, but it's the one that I feel the most comfortable with. Even though Warren Buffett is leaving at the end of this year, for the past 10 years at least, he's been operating as if he was going to either leave or pass away. I mean, he's quite old. And so he has been handing over the reins for quite some time. And what I believe is he's just such a thorough, I mean, so thorough in whatever he does. Investing is one thing, but being a business owner and a leader, he has been setting up the successor to just kill it when he leaves. And so he's leaving them with 350 whatever $billion to be able to play around with. It's already a company that has crazy margins. It's one of the only companies that over the past 30, 40, 50 years has actually beat the S&P 500 consistently. So, I mean, there's just so many different reasons, but for me personally, I know, or I suspect that at the end of the year, maybe beginning of next year, that stock will probably fall because he's leaving. And I think that I'll be scooping up a bunch right then. And I think that it's going to go off without a hitch and they're going to keep going. How about you?
Yeah. Well, just kind of harping on Berkshire a little bit more, I think the fact that they have so much cash gives them two things. Number one, it gives them resilience. So if and when tough times do occur, they're going to be able to weather that storm just because they have such a fortress balance sheet. But number two, also it's going to give them tons of optionality. If things hit the fan, they can take that cash and put it to work and scoop things up and grow the business at the most opportune time. So yeah, that's gonna be a hard one to beat. And thinking about this question, I think on a similar note, I'm kind of thinking about things that are not going to change. Okay, like I have no idea what the future is going to hold. There's going to be so many changes between now and 15 years from now that it makes my head spin to even think about. So I'm thinking about what are the things that in that time I can rest assured are going to be consistent. And these two that I'm going to share, I have two is three companies, but like two kind of industries. And they're going to be pretty obvious. The first of which is I would bet my pants that 15 years from now, people are still going to be brushing their teeth. They're going to still be using toilet paper. I hope so. They're going to be using diapers. They're going to be using laundry detergent, dish soap, shampoo, conditioner, deodorant. They're going to be using all these things. And for that, or because of that, I would feel very comfortable and will feel very comfortable owning a company like Procter and Gamble for the next 15 years. Now, you can expand it beyond just Procter and Gamble. There's some other companies, kind of doing similar things. Colgate Palmolive is another one. I think you could even throw Clorox in there. Now with the merger between Kimberly-Clark and Kenvue, I think you could kind of go with something like that. But out of the bunch, Procter and Gamble is my pick. It is the one that I have in my portfolio. So I would feel great owning that company for the next 15 years. Now, this other industry is once again going to be very obvious, but another thing that's not going to change about people is the fact that they're going to have trash, they're going to have garbage. And someone is going to need to deal with that garbage. And for that, I think you could sleep just fine at night owning a company either like Waste Management or Republic Services Group. Republic Services Group is the one that I probably am a bit more partial to, only because, and I have a very specific bias towards it, only because they're the ones who pick up my garbage. They service the entire Las Vegas area, so it's the one that I'm most familiar with. So, but I don't think you could go wrong with either of those two companies. And they've actually just been behemoth performers over time. So I'd feel very comfortable owning any of those companies. And there's quite a handful more, but generally speaking, like I said, I'm thinking about things that are not going to change. And I would say that approach or that mindset is really baked into my entire investing strategy. I really gravitate towards those things just because I'm such a simpleton and I just have no idea what's going to come next. So it makes me feel comfortable and it makes me sleep well at night, knowing that I own things that are still, going to be relevant in the future.
Yeah, I like that. I really like that that's the way that you took it. What's not going to change? Kind of like the book Same as Ever, right? I know
Great
both of
book.
us
Yeah.
read that one.
Yeah.
But yeah, no, I mean that's a great way to think about it because in investing, you could have something that's hot for 3 years, 5 years, and it could be crushing it. But as soon as that fades or just it dies out, that's not a good thing to be holding in the portfolio. So something that's slow and steady. I mean, nobody ever thinks about Waste Management, but if you really look at their numbers over the last, forever, it's some solid numbers right there.
Yeah. And I will say, I want to preface this too, not preface it, but I want to kind of add a sort of disclaimer, some more context. I'm someone who, as I think we all should be, I have a really multi-generational approach in my portfolio. So I think that also adds to that, just not feeling like I need to rush and reach for gains. I'm okay taking, and I know I listed some really boring companies. You guys are going to think I'm a boomer, invest like a boomer, but I'm not in any rush. Like the things that I'm doing today, the companies that I own today, it's not just for me down the road. This is also for the people that come after me. And so I think when you allow yourself to play that infinite game and not set some sort of finish line, I really think it opens it up to take a more slow and patient approach. And once again, just going, in addition to things that don't change, that's another thought that's also very baked into my investing strategy. I get a lot of slack for it, but it's okay.
I love it. I think it's wise beyond your years, to be honest. But I've seen it. I've seen it with my private clients. The ones that did that slow and steady for 40, 50 years, they're happy that they did it. And the ones that tried to get it done in like 3 years or 5 years or whatever, they took on a little too much risk, and they're the ones that probably are still working at this point when maybe their friends are retired. And so I think that that perspective is really, really healthy in the world of investing. If it seems too good to be true or it's a get rich quick thing, it's probably not going to work out for you. Spoiler alert.
Well, nice, man. So those are all the questions that we had today. I want to, number one, Nolan, thank you for taking the time to do this with me. Like I said, man, it's been too long since we've done a video together. That is all my fault, by the way, everyone. I will take the blame for that. So thank you for taking the time, man. It's always good hanging with you and catching up with you. And also, once again, thank you to everyone in the audience for tuning in. Really appreciate your guys' questions. And I hope we can do this again sometime soon because this was fun. It's always fun.
It's always good to catch up, and great questions, everybody. Thanks.
All right, guys. See you later.